Hello traders at CMC Markets. Welcome to a new update by RRG Research for Monday the 21st of November. And I am recording this on Thursday night evening after the close of the US markets. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. It used to be Trevor Neal's turn this week, but he is traveling to Paris, so I'm stepping in for him, and very likely he will be back next week. Let's kick it off with a look at the world market indices as usual. And this week's relative rotation graph for world indexes actually shows a pretty interesting picture, because as you can see, there is a quite distinct difference or split, if you wish, of a group of markets which tails are traveling clearly in that northeastern direction, or RRG heading between 0 and 90 degrees, like the DAX and the stocks, the CAC index. Those are all markets that are doing really well. They are traveling higher on both scales, which means that there is a relative uptrend versus the MSCI World, and that uptrend is getting stronger by strong momentum. So those are the good markets. They are doing really well. On the opposite side, we have a number of tails that are moving in that southwestern direction. Think about the Hang Seng Index, which is leveling off a little bit here, but very clearly the American Nasdaq Index, the S&P 500, the FTSE, the UK index, and the Japanese Nikkei index. Those markets are traveling at a negative RRG heading between 180 and 270 degrees. So when you see this type of rotation on an RRG, it's great to find good pair trading opportunities because there is such a clear difference in the direction of the rotation. Again, this is a weekly RRG, so this is looking at a little bit longer term trends. You don't have to be in a hurry to do this. If we bring it to the daily RRG, you can see that it's a little bit less distinct. Those trails are a little bit more volatile, quite hooky, but the big picture remains the same. And if we zoom that in, if we take away that Hang Seng Index and we look at those rotations here, then you can see very clear directions for the DAX, for the stocks, basically for the European markets, CAC, and then the UK is the exception. And then you got the Russell 2000, you got the S&P, you got the Nasdaq, and here is the Nikkei index, which was very strong and is now rolling over. So for this occasion, I want to go and take a look at some of these world markets. Last week we focused on the Nasdaq and the DAX index. So this week I want to take a look at the Nikkei, for example. So that's the trail that is moving from leading into weakening and heading towards that lagging quadrant. And if you look at the price chart of the Nikkei index, then you can see that the price is captured between two horizontal layers, causing a trading range type of movement. And you can see that the RRG lines are both moving lower. So what that basically tells you is that this rally in the Nikkei is not strong enough to catch up with what's going on in world markets. That's making it a market that is now losing relative strength and relative momentum. And we are running into resistance, so the upside potential for the Nikkei index at this moment is quite limited. If you bring that to the daily chart, you see it at a little bit more granular aspect, and you can see that the first layer of resistance was here around 28,300. If we get above that, but it looks as if we've already put a peak in, then the next level, the next overhead level is just above 29,000. RRG lines now clearly moving lower on that daily scale, so that makes the Japanese Nikkei index a market that is most likely going to underperform the MSCI World in the coming weeks. If we bring it to the FTSE, to the UK index, then you can see that that market, in terms of price, actually rallied towards overhead resistance. We can draw a line that connects the last three major peaks here, and we're kind of at that level, but not much higher. Around 7,600, 7,700 is already a very heavy horizontal resistance level. And if you make the chart a little bit bigger, you can see that this whole area is very heavy overhead resistance for the UK market, for the FTSE. And here also the RRG lines, after a little jiggle, they're now rotating lower. Both lines are pointing down, which makes the FTSE a market which is likely to underperform in the coming weeks. Now that is kind of confirmed by the price development on the daily scale. RRG lines clearly rolling over, and you can see that it looks as if we're getting a peak into place here. Market is playing around with that 20-day moving average, but we didn't even reach the upper boundary. We didn't even reach that falling trend line that connects 1, 2, 3, 4, maybe 5 highs, 5 recent highs since May. So that's quite a reliable trend line, quite a reliable resistance area. So again, FTSE, limited upside potential, downside, the risk is clearly to the downside. Now on the opposite side of the market, we find the European stocks index. This is a stock 600. And you can see the difference immediately. Here we had that downtrend. We bottomed out at what was the high in July 2020. And you know that old highs become, or old resistance becomes support and vice versa. So here we see that old resistance area around 375, 380 becoming a support level in the last couple of weeks, which was also the lower boundary of that falling trend channel. And that rally off that double support area has now broken above that falling trend line, while both RRG lines are moving higher. That makes the European stocks index much more attractive than the Nikkei and the FTSE for the time being. There's overhead resistance just above 440, but if this is a real turnaround, then obviously the former all-time highs can definitely get into sight. If you look at the stocks index on a daily scale, then we can see that this is the same trend line as we had on the weekly. And you can see that we broke it and we're now testing that old resistance as support. This is going to be very important for the stocks index in tomorrow's trading, which is Friday and Monday when you see this. So if we can still hold by Monday evening, Monday close, above, let's say 430, then we can probably safely state that that resistance has been broken and there is new upside potential for the European market. I want to quickly finish off this video with a look at the US sectors. We haven't looked at that for quite some time. And as you can see here, the most important rotation, I think, is for the consumer discretionary index. It is now clearly inside the lagging quadrant, which means that it is at a underperforming, a relative downtrend versus the S&P 500. In that same quadrant, you also find the information technology index, which is picking up slightly over the last week, but the main trend is still moving lower on the RS ratio scale, which is a negative, and that's the same for telecommunication services. That sector is underperforming for ages, and you can see that real estate is still moving lower. But the two most important sectors, information technology and consumer discretionary, are inside the lagging quadrant and moving lower on the RS ratio scale. On the opposite side, we find healthcare, financials, industrials, and consumer staples as the stronger sectors, still moving higher. And energy obviously is a bit of an outlier. It's the strongest market, the strongest sector for the time being. But the question is, has it already run its course, or will it continue to move there? There are some very nice stocks to be found inside that energy sector, breaking to new all-time highs. So it's definitely not a sector to short. Let's be very clear about that. But I'm not sure whether the potential that is still left in that sector weighs up to the potential that you can see here in staples, industrials, healthcare, financials. The one thing that is quite strange, or something that you need to keep in the back of your head, is the fact that healthcare and consumer staples are two very defensive sectors. They're still moving higher into the leading quadrant. But the other defensive sector, which is utilities, is now moving into the lagging quadrant. And what you usually see is that those defensive, and of course also the cyclical offensive sectors, are moving more kind of in tandem. So you would actually expect utilities to be up here with healthcare and staples, but they're not. So even if you want to go for a defensive play, I think it's now better to watch for stocks inside the healthcare sector and inside the consumer staples sector, and leave utilities for what they are at the moment. That's a wrap for now. Thank you for watching, and I hope to see you again at a new update by RRG Research next time, next week, same time, same place.